Most people think credit cards are a trap, and for many people, they are. Debt grows, interest piles up, and financial stress becomes a normal part of life. But wealthy people often use the same credit cards as powerful financial tools. The difference is not the card itself, it's the mindset behind it. Rich people understand that credit cards can either destroy wealth or help build it. While average consumers use credit cards to buy things they cannot afford, wealthy people use them strategically to increase convenience, earn rewards, protect cash flow, and build financial leverage. Here's how the rich use credit cards differently. Number 1. They never spend more than they can afford. One of the biggest differences is simple. Rich people usually don't use credit cards to borrow money. They use them as a payment tool. Many people swipe their cards emotionally. They buy expensive clothes, gadgets, or vacations without having enough money in their bank account. Later, they struggle to pay the bill and end up trapped in high-interest debt. Wealthy people think differently. Before they spend, they already have the money. The credit card is only used for convenience, security, and rewards. They treat it like a debit card, not free money. This mindset changes everything. Poor mindset: I'll pay for it later. Rich mindset: if I can't pay it off today, I don't buy it. Number 2. They pay the full balance every month. Credit card companies make billions from interest payments. Most average users carry balances month after month, paying huge interest rates that slowly destroy their financial future. Rich people avoid this trap. Instead of paying the minimum balance, they pay the entire amount every month. This means they never waste money on interest. Why is this important? Because interest works against poor people, but works for rich people. Wealthy individuals prefer earning interest through investments, not paying it to banks. Imagine two people. One pays 25% interest on debt. The other earns 10% annually through investments. Over time, the gap between them becomes massive. The rich understand that avoiding unnecessary interest is one of the easiest ways to protect wealth. Number 3. They use credit cards for rewards and benefits. Most people ignore the hidden value inside credit cards. Wealthy people don't. Rich individuals often choose cards with cashback rewards, travel points, airport lounge access, purchase protection, fraud protection, hotel upgrades, business rewards. They use these benefits strategically. For example, a business owner may spend thousands every month on advertising, travel, or business expenses. Instead of using cash or debit cards, they use reward credit cards to collect points and cash back. Over time, these rewards can become free flights, luxury hotel stays, business class upgrades, thousands of dollars in cash back. The rich understand a simple rule: if money is already being spent, make it work for you. Number 4. They protect their cash flow. Cash flow is extremely important to wealthy people. Instead of immediately removing money from their bank account, they use credit cards to create short-term flexibility. This allows them to keep cash available for investments, emergencies, or opportunities. For example, a wealthy entrepreneur may use a credit card for business expenses, while their cash remains invested in assets generating returns. This doesn't mean they avoid paying bills. It means they manage timing intelligently. Average people focus on spending money. Rich people focus on controlling money flow. That small difference creates financial power over time. Number 5. They build and protect their credit score. Too many wealthy people, a strong credit score is like a financial reputation. Good credit gives access to better loans, lower interest rates, real estate opportunities, business funding, financial leverage. Rich people know that banks trust people with responsible financial behavior. So they pay bills on time, keep credit utilization low, avoid unnecessary debt, maintain long credit history. A strong credit profile allows wealthy individuals to access opportunities faster and cheaper than average people. In many cases, the rich use debt strategically to buy appreciating assets like businesses or real estate, while poor people use debt for liabilities like phones, fashion, or luxury items. Number 6. They separate wants from investments. One major psychological difference is how rich people think about purchases. Average consumers often use credit cards for emotional spending, impressing others, instant gratification, social status, luxury they cannot afford. Rich people usually ask, will this purchase make money or lose money? They avoid using credit cards for liabilities that drain wealth. Instead, they focus spending on education, business growth, investments, productivity tools, networking opportunities. The rich understand that every dollar has a job. Money should either grow, protect, create future income. If a purchase does none of these things, wealthy people often avoid it. Number 7. They understand financial discipline. Credit cards reveal a person's financial psychology. For many people, having a high limit creates temptation. They feel richer than they actually are. This leads to overspending and long-term debt. Rich people control emotions better. They understand delayed gratification, the ability to avoid temporary pleasure for long-term success. This is why wealthy people often appear financially calm. They don't buy everything they want immediately. They focus on long-term freedom instead of short-term excitement. True wealth is not about looking rich. It's about staying rich. Number 8. They use credit cards as tools, not status symbols. Many people choose credit cards to show off. The rich usually care more about function than appearance. A wealthy person may choose a card because it offers better travel protection. It gives higher cashback. It improves business efficiency. It provides financial flexibility, not because it looks expensive to the rich. A credit card is just another financial tool like a calculator or investment account. Tools are meant to create value, not impress people. Final thoughts. Credit cards themselves are neither good nor bad. The real difference is the mindset behind their use. Poor financial habits turn credit cards into debt traps. Smart financial habits turn them into wealth-building tools. The rich use credit cards differently because they think differently. They spend with discipline. Avoid interest. Use rewards strategically. Protect cash flow. Build strong credit. Control emotions. Focus on long-term wealth. In the end, wealth is not created by earning more alone. It is created by managing money wisely. And sometimes, the smallest financial habits reveal the biggest difference between rich and poor thinking.